got three nationally renowned Opportunity Zone attorneys and members of my mastermind group, OZ Insiders, joining us today for our Ask the OZ Experts panel. Andrew Daup of Syndication Counsel in Columbus, Ohio, Brett Siglin of Finnemore Law in Phoenix, Arizona, and Ashley Tyson of OZ Pros in Charlotte, North Carolina. And the way this session works is if you have any questions about OZs for me or for any of our panelists, these are three legal experts in the area of opportunity zones and real estate and business. So ask your questions in the chat or the Q&A, and we'll get to as many of them as we can over the course of the next, we've got about 40 minutes until I got to cut it off for the next presenters. But gentlemen, great to see all of you. Andrew, Brett, and Ashley. Maybe just quickly, just 1 minute intro. And what do you think about OZs in 2025? Andrew, we'll start with you.
Hey, good morning, everyone. Thanks for having me, Jimmy. Look forward to this panel with Ashley and Brett. My name is Andrew Daup. I own a boutique law firm that helps entrepreneurs navigate compliance with securities laws to raise investor capital with confidence. We are syndication counsel, and as an extension of that practice, we've developed some deep expertise in opportunity zones since 2019, the very early days of the legislation. And if you feel like you're behind the learning curve when it comes to opportunity zones, I guarantee you, you're not. As you'll learn later on in today's programming, there's a lot of excitement about what the future of the OZ legislation can look like. So you're still very early on in this program. So congrats on being here and taking that step and learning more about it.
That's right. Brett, on to you. What do you say?
Hey, I'm Brett Siglin with Finnemore. I'm a director here. Thanks, Jimmy. Andrew, Ashley, great to be on this panel with you guys. I'm based in Phoenix, Arizona, and I do a lot of work like Andrew does in syndication of OZ fundraisers, do a lot of work in the tax credit space. I've been a tax advantaged real estate lawyer for about 20 years now. And, we're a firm based in Phoenix. We do work all over the US, and we've been quite active in the OZ space, just like these other gentlemen for the last 6 years.
Awesome. Brett, great to have you here as well. Ashley, the Sherpa, what do you say, bud? And where are you today?
So I was close to an opportunity zone in Columbia, South Carolina, but I'm actually on the way to an event down at the Cloister at Sea Island. I thought that I was going to be able to get down there by then, but traffic and everything else being what it is, we pulled over in close to an opportunity zone. The problem with opportunity zones is that they don't have Starbucks. Because the demographics, right? Or maybe there's a couple of them that do, but very rare occurrence, and certainly not so down here in Columbia, South Carolina. But I'm in Columbia. So Jimmy, you and I founded OZ Pros back in, I think that was 2019, and we set about becoming the legal Zoom for opportunity zones. And I think that we've probably set up more opportunity funds than anybody else in the country. And certainly I think more opportunity zone businesses. And that's what we specialize in. We specialize in setting up bespoke qualified opportunity funds. You call them bespoke, call them captive, call them, self-directed, however you want to kind of phrase that. But, for somebody that wants to have their own fund to potentially invest in other folks' QOZBs, like the folks that you have here, on the show today, or if they want to do their own deal. And then, out of that, we've because we have so many clients that we've helped, we have now started doing compliance for everyone as well. And I think that that's one of the kind of the things that gets people comfortable, is knowing that they've got somebody I've literally been doing nothing but opportunity zones since May of 2018. And so we help people to make sure that they're doing them correctly. And, that's kind of our mantra, is we help people do opportunity zones. So for 2025, I think that that's the lesson is, the old Chinese proverb is, when was the best time to plant a tree? 30 years ago. When's the second best time to plant a tree? Right now. And a qualified opportunity fund that you have started to age with your investment is going to be an extremely valuable vehicle in 10 years from now. And so the answer is, get it going now And, if we get the extension, that's great. If we don't get the extension, oh well. You've got your opportunity zone fund started, and you've got it rolling to where you're able to take advantage of that really valuable step up in basis to fair market value after 10 years. That's what I think 2025 is for. It's the time to get it done.
Good stuff, Ashley. I love it. All right, well, let's start with the questions. As I said, we've extended this panel from the usual 30 minutes to 45 minutes. We got a little extra time today. I was going back and forth with Tim in the Q&A section a moment ago. Tim has a situation where he has a $4.25 million capital gain. He put it into his own captive qualified opportunity fund. He's already deployed $2.6 million into OZ projects, but he's got another $1.6 million, $1.65 million of dry powder essentially in his QOF. And he's asking, how much longer do I have before I have to deploy that dry powder? And I said, well, it kind of depends. It's usually between a 6 to 12 month period, but can one of you clarify for Tim?
And I actually answered this one in the chat, and he's got till June 30th of next year, because he gets to disregard it because it came in during that period of time prior to his to that year-end asset test. So he gets the disregard for that one. It kicks him to the next one, and he's got till June 30th of next year.
Of next year, so that's even longer than I thought. All right.
Yep.
Any other thoughts there? Are we good to go to the next question?
If I could add, so this question involves compliance with what's called the 90% investment standard, and that's a standard that applies to the Qualified Opportunity Fund. And as Ashley alluded to, the answer very much depends on your own facts and circumstances. It comes down to timing. So it's really important to have a good gauge on what your timing requirements are to maintain compliance, because if you bust that timing requirement, then you're going to be subject to tax penalties. There is a lot of flexibility with what you can do with pre-tax deferred gain. Once you get it deferred into a fund, you could use it to invest into a Starbucks for Ashley, for example. But you got to make sure that you're keeping a pulse on the status of your 90-day or your 90% investment standard for your QOF.
Yeah, good point there, Andrew.
Andrew's trying to take us down rabbit holes already, man. I love it. He's talking about the 10%, that you can do inside of the QOF that you can put into whatever you want. I love it.
Yeah, well, somebody's got to pay attention to the details, Ashley. All right, so let's go to Steve's question here. I think this is a pretty simple one and somewhat common, I think. Steve has $100,000 that he wants to invest in an OZ fund, but only $50,000 of it is capital gains dollars. The other 50%, the other 50K will be non-gains dollars. How do those get tracked by the deal sponsor for tax reporting? And my understanding is the deal sponsor doesn't have anything to do with that. You have to track it on your end. But what have you gentlemen seen?
Yeah, not necessarily, Jimmy. I think it's important for a sponsor to track that. I mean, typically, you're going to try to attract investors in your QOF that do have ripe capital gains, but this happens frequently where you've got a gentleman like that where maybe 50% or more is capital gains, and then he's got 50% that's not capital gains. So there's ways to play that. I mean, you can put the capital gains in obviously as equity now, and then maybe loan in the other 50 and wait for another gain to come in. That might be a good strategy. And then you can be sure that 100% of your interest is going to get that exclusion benefit after 10. Or, you can still track it separately as equity, and we've seen that as well.
So under the regs, QOFs are obligated to track if something is a qualified gain or a non-qualified gain. They're actually required to keep two separate accounts for that. And the reasoning is because that they want to make sure that there is, confirmation even at the QOF level about whether or not they're going to be eligible for that 10-year step up in basis at the end of the time. To Brett's point, you could always swap out that non-qualifying interest for qualifying interest later on, but the fund sponsor is going to need to track that.
Yeah.
Okay, good stuff.
And I'll add as well, one of the early questions beginning of pitch day was, can I invest post-tax cash into a qualified opportunity fund? So to be clear, the answer is yes. However, that investment of post-tax cash will not be entitled to the special federal OZ income tax incentives. To Ashley's point, the QOF sponsor is going to want to help you keep track of how much of your contribution is eligible gain and how much is not eligible gain or post-tax cash. And this is actually really common here in Ohio. We've already mentioned this Ohio state income tax incentive in the form of a 10% tax credit. State of Ohio makes no distinction between investments of pre-tax capital gain and post-tax cash. You're going to be eligible for that 10% state income tax credit either way. So a lot of Ohio qualified opportunity funds are actively soliciting investments of post-tax cash and then issuing two separate classes of membership interests to help keep tabs on, who's investing what type of money.
Great stuff. Okay, well, I stand corrected then. I didn't realize that it had to be separated out like that. So that's good to know. Great question. Thank you. Let's see. Ashley, I got this one from Dave very early in the program before you were even here, but he addressed it to you. He says, Ashley Tyson, you had mentioned that capital gains invested into QOFs are exempt from the estate tax / death tax. Is that still true? And then this person goes on to ask about IDIGTs. So talk to us a little bit about that.
Idiots, baby, idiots. So it's not exempt, right? But the way that it works is, and this is the reason why I regularly call qualified opportunity funds kind of a poor man's irrevocable trust, is that when you put money into an irrevocable trust, or when you put it into a qualified opportunity fund, it effectively freezes the value of that for purposes of the lifetime exemption on your estate. So the way that the estate tax works is that you have a lifetime exemption amount. That amount, it's like around $14 million per individual right now, so 28 for a married couple. And at the time of death, it's based upon the net asset value of all of your estate. Now, if you have already conveyed stuff into an irrevocable trust, that freezes the value at the time that you conveyed. And a qualified opportunity fund effectively works the same way, because when you convey it into a qualified opportunity fund, it's the value at the time that you conveyed that goes against your estate if you die before 2047. So effectively, your estate steps into your shoes, and then so it's going to be at the value that you put it in, not at the fair market value at the time. That's the reason why we like opportunity zone funds. Now, IDGITs are called, that stands for intentionally defective grantor trust. And an IDGIT is a very effective tool for, once again, freezing the estate value. So it freezes your estate value for the ultimate, for your ultimate estate, but it still functions as a grantor trust for purposes of filing it on your tax returns. That's really important for opportunity zones, because you need to make sure that the IRS is going to treat it as coming on your tax return as opposed to filing its own tax return. Because if you convey your interest in a QOF into a traditional irrevocable trust, which is a non-grantor trust that files its own tax return, that's going to trip an inclusion event. An intentionally defective grantor trust will not.
Awesome stuff there, Ashley. Let's move on to this next question from Nick. Nick asks, can you please clarify on acquiring an OZ asset using capital gains and debt, right? Because an OZ project, just the OZ equity part can just be one part of a much larger capital stack, right? A couple part question from Nick. He asks, to maximize step up in basis after 10 years, should the debt be paid off before the 10-year mark? And can this debt be paid down using non-capital gains money? So how is debt handled basically with an OZ project?
There's a lot of flexibility with debt, right? I mean, it's one of the advantages to, I think, this incentive. I think Ashley and I both agree that you probably don't want to leverage more than 90%, just because there's kind of a standard in the federal government, generally through the SBA and other subsidized programs, where, generally more than 90% debt is probably, questionable. But if you have, up to 90% debt, you can include that, and there's no requirement as to when it gets paid off. So you could have that 10% or more equity. You could leverage as much as you want, and then hold it for 10 years, ideally, or even potentially, refinance in 3 to 5 years, and then, you can use pretty much any source to pay off that debt, and you could even potentially sell the project after you refi and invest those proceeds into other opportunity zone properties.
Any other comments, or should we move along here?
Yeah, I agree with that. You know, the great thing is that you can use debt. There's no requirement that you have to pay it off before you sell.
Good
Right.
stuff. All right, go ahead,
Yeah.
Andrew.
No, I guess I would add, there's a good reason to leverage your pre-tax OZ equity with debt as well, and it's so that you get basis in your qualified opportunity fund, which means you can then take distributions of net cash flow without triggering recognition of the amount of gain that you deferred. I know that's super technical, but basically what it means is if you borrow debt, you can start taking distributions of cash flow.
All right, well, let's move on to this next question here. This comes from Ginny, and Ginny asks, is it possible to buy someone else's OZ fund if they decided not to pursue it? And if we can get liability exposure limited sufficiently? COVID apparently prevented some organizations from implementing their plan. So what do you gentlemen know about acquiring OZ funds via purchase?
You can definitely do it. The issue though is that it's like if you're going to buy their qualified opportunity fund interest, it's just going to reset the 10-year clock. So if you really like that project, I guess that's technically doable. I'd really query as to why it made sense to actually buy their interest. Now, if they've already done and they've worked on like, you know, substantial improvement and that's already occurred, then that might be one of the reasons to buy somebody's qualified opportunity fund interest. But you're going to reset the 10-year clock when you do that.
Yeah, I would agree that it's probably going to make more sense to set up your own QOF and just, you know, step in. It's going to be a lot cleaner. You generally don't want to step into the shoes of another fund, especially if they're having problems.
Yeah, and I'll add if they are having problems, then there may be an opportunity for them to merge their OZ fund into yours, so that you combine forces to possibly overcome the challenges that they were facing.
Excellent. Well, let's move on to this next question. This just came in the chat from Melissa Abrantes. She's one of our more recent additions to my OZ mastermind group at OZ Insiders. So I want to get to her question. It's kind of a follow-up to a question we discussed a moment ago. She asks, can you share more about the basis with borrowing debt versus paying cash for a value add project?
Yes. I'll kick this off. So when you contribute pre-tax deferred gain into your OZ fund, you have zero basis. And this is very different from what happens outside of the OZ world. Normally in a partnership, when you're contributing cash, you get tax basis in the partnership in an amount equal to the cash that was contributed. In OZ world, you're contributing pre-tax cash. So you actually don't get that tax basis in your OZ fund. So you need to figure out if you then use that pre-tax cash to invest into an asset, that asset produces some revenue, you want to be able to make a distribution of that revenue. You're going to have to figure out a way to increase your basis in that partnership. One way to do that is for the partnership to borrow debt. So that each partner in that partnership gets their share of partnership liability. What that in turn does is it enables the partnership to make distributions to each partner without triggering a recognition of their deferred cap gain, because their basis increases proportionate to their share of that partnership liability.
Brett or Ashley, anything else to add there, or should we move along?
I think you covered it.
Good stuff.
Yeah,
go ahead.
The key is that debt piece, right? And like when you get that debt, that's what's going to give you the basis, because you can't allocate losses in excess of basis. So that's relevant if you want to try and take those losses prior to December 31st, 2026. But if we don't get an extension, or when we do get the extension, whatever the date that the taxes become due, that's when their basis will drop. And they will now have basis in the deal, and so they could take the depreciation and any losses up to the extent of that basis. So prior to December 31st, 2026, no basis unless they have debt. After December 31st, 2026, they have basis up to the amount that they put into the deal.
Right on. All right. I've gotten a few questions today, and I just got one a moment ago about, is this being recorded? and can I get access to the recordings? Can you give me the recordings? So yes, we're recording this entire event from start to finish. Give us until tomorrow, and over the weekend, we're going to get a lot of these recordings up, and eventually by early next week, every single segment will be up on our website at ozpitchday.com. We'll also post them to our YouTube channel. If you haven't already subscribed to our YouTube channel, I would highly encourage you to do so. You can get to that YouTube channel by clicking the link that I just typed into the chat, or head over to youtube.com/opportunitydb. Now let's move on to some of our other questions here on the list. Kalila asked a little while ago, could you explain the OZ business option? Can a business owner with a closed business use that property and facility to structure a certified OZ business fund? Maybe speak about establishing OZ businesses as a QOF strategy for a moment, gentlemen.
Yeah, so we deal with this all the time, and I think that it's probably one of the kind of most it's talked about a lot, but up until kind of the last couple years, not a whole lot of people were doing it. And we've seen a massive spike in, operating businesses taking advantage of the opportunity zone legislation. And they're doing it for startup businesses. They're doing it for like regular businesses. We've actually helped a number of people close SBA deals where they're actually acquiring businesses inside of the zone, or they're acquiring them outside of the zone and moving them into the zone. And the reason why they're doing this is for twofold. Number one, it allows them to take capital gains money and put it into the deal. Number two, it allows them to then exit it after a 10-year hold, and to do so capital gains and depreciation recapture free. And then, kind of a third benefit as well is, if to the extent that they're trying to raise money, now they can accept cash from other qualified opportunity funds. So we actually helped a group that is a C Corp. They had a bunch of safes in place, and we converted them to a QOZB so that way they could take advantage of this. They're running a parallel Section 1202 qualified small business stock exemption, but the opportunity zone allows for a couple things inside of that parallel activity. First, it allows you to, if you are over 10x or $10 million in gain, it makes it so that you can just use the opportunity zone benefit instead. And then secondly, if somehow they mess up their 1202 compliance, then they can fall back on the qualified opportunity fund status.
Yeah, and I'd reiterate, I mean, the incentive was really designed for this, right? 6-7 years ago, although we haven't seen as much as people might have hoped when Congress was contemplating this back in 2017. I agree. There's tremendous opportunities to combine the qualified small business benefit with the OZ benefits. And it's interesting to think about what might be proposed in the legislature to encourage more business development. Although we still obviously see tons of real estate deals.
Yeah, I share Ashley and Brett's enthusiasm for OZ businesses. Because really there's almost no limit on what you can do by way of capitalizing an operating company with an investment of pre-tax deferred gain, save for like 7 or 8 categories of what are called sin businesses per the Internal Revenue Code. And those are for things like, those are things that the IRS or the Treasury Department didn't necessarily want to incentivize the formation of in opportunity zones. What are the common categories? Carry out liquor stores, massage parlors, suntan facilities for some reason. And there were a few other examples as well. But, generally,
I think the golf course was a shot across the bow at Donald Trump.
I think
it was parallel the new market tax credit, but I love to kid around about that.
Those businesses have been in the NMTC regs for 25 years for whatever reason, so we can't give Trump too much credit, right?
Yeah, it predates Trump by a little while. By the way, I recently learned there's actually more golf courses in this country than there are McDonald's franchises, which is kind of interesting. So I don't know why golf courses. It is, isn't it? I don't know why there are why golf courses are a sin business. Somebody asked, "Hey, how do I connect with these guys if I want to hire them to build my own OZ fund instead of investing in existing funds?" I did post links to all of their email addresses in the chat. little while ago. You might need to scroll up, but Andrew Daup, Brett Siglin, and Ashley Tyson, great attorneys. Any one of these individuals can help you with that. Tracy's the one who asked that question, so thanks for that, Tracy. Let's talk sin business, or maybe gray area businesses, for a minute, because we've got some questions about cannabis. We've got some questions about Bitcoin and crypto mining. First question, can OZ work for cannabis? And if so, how? And I think it might depend on what state you're in, but at the federal level, I think cannabis is still illegal. So it's a little bit gray area legally, but love to get your take on that topic, gentlemen.
Brett, this is all you, man.
Yeah, I mean, it's clearly not designated as one of the sin businesses, but yeah, I think anytime you're taking federal benefits of any kind and you're dealing with, a business that's, on that sort of criminal list or list, I forget exactly what they call it in the Justice Department, but I'd say I would shy away from it.
Andrew, you were about to chime in, I think.
Go ahead, Andrew, and then I'll round us out.
Yeah. Actually, this is a question back to Brett, because we're talking about sin businesses and how that applies to qualification as a QOZB. Do investors still need to be concerned with that compliance requirement if there is no QOZB involved, if they're investing directly through a QOF?
Well, so you're saying, the QOF doesn't have to satisfy the sin business requirement. And yeah, I think you're right, Andrew. Although you're still potentially operating a business that's questionable in a number of states, and there's still federal benefits. So yeah, I get back to the same place.
Yeah, and I don't disagree with you. I was simply wanted to explain that this sin business requirement, it doesn't actually apply to investments made by a QOF unless those investments are made through a QOZB.
But nobody does that, right? I mean, there's almost no QOFs that are doing businesses because you lose out on the safe harbor and many other benefits, right? So unless there's a ground lease or some other way to do that, I haven't seen anybody do that with a QOF lately.
All right, good stuff, gentlemen. Let's move on to another kind of gray area.
I'm actually going to address
Ashley.
that one real fast too. This is my final thought on it. I literally just got like a smoothie from like a health food store here in Columbia.
Because there was no
about as
Starbucks.
hardcore. South Carolina is about as hardcore like non-cannabis as you can get. And there was a lady buying what really appeared to be weed at the counter. And so I think they've got this whole workaround where it's not cannabis, right? Because it's at a certain threshold, but these things are all over the place now. So I'm kind of curious about the whole reason why you actually even need a cannabis store anymore, because they're selling it everywhere and it sure walks and talks like weed to me.
Now they're smelling it at the smoothie store. What does the world come to? Okay, well, let's move on. Let's talk about Bitcoin and crypto for a minute, because we got a couple questions about those topics. Let's see. I had one here from Brad. Brad says, hey, gents, great show so far. Thanks, Brad. Brad's always awesome, always attends these, and love getting his questions. He wants us to discuss non-fungible tokens, or NFTs, and opportunity zones for a few moments. He's curious on your view of whether folks could create a QOZB to create and sell an NFT as a business. Would it / could it qualify as a trader business under the regs to meet the QOZ test of active trader business if the company is actively raising money and selling tokens and serving as a platform for crypto investors? Interesting idea, Brad. Love to go around the horn, get everybody's thoughts on that one.
I absolutely, and I love Brad. He's fantastic. One of the sharp. I mean, he's one of the OG QO Opportunity Zone folks as well. And I think that this is a real opportunity for folks, because I think that if you are actively working inside of a zone, that it doesn't really matter what the business is, unless it's a sin business. And certainly crypto companies aren't a sin business, that you could absolutely create NFTs. Right? Like, I think that you could have like a museum where you convert art into NFTs. I think that you could actually have a business that just stakes. As long as you're doing that from an opportunity zone, I think that that's legit. I also think that if that's your business in the zone, that gives you a compelling reason as to why you need that intangible property and how you're using that intangible property in the trade or business that's happening inside of the opportunity zone. So, because there's 5 tests for a QOZB, one of which is that 40% of your intangible property needs to be used in the trade or business that's happening in the zone. And I think that if you're regularly minting NFTs, if you're doing some kind of activity actually inside of the zone, and I think that you got to be real careful about that, that you actually need to go to an opportunity zone to do that, that I think you're fine.
Yeah,
Brett or Andrew?
I'll echo Ashley's enthusiasm here as well, because again, with the exception of the handful of sin businesses that are expressly prohibited in the statute, generally you're the only limitations your imagination here. What's super interesting about this industry at this time is that it's constantly changing and constantly evolving. So I think it was just the other week, the SEC actually said meme coins are not a security even, they're collectibles. So how does that change our analysis from a regulatory compliance perspective? I think it creates a lot of possibilities that, possibly, wouldn't have been explored before.
This
I would
kind of
just
goes
warn on
into
the side of caution here. I mean, it's got to be really important that you're not just trading crypto, that you really have an active business, that you've got employees, that you've got a presence, ideally in some kind of office space, that it's not just non-qualified financial property, because I think of the 5 tests, that's the easiest one to trip up on. And it's pretty strict. Once the safe harbor burns off, you've got to have, less than 5% be non-qualified financial property. So as long as your crypto business can satisfy that mold, then
and
have
and
at it.
to Brett's point, because I am all about walking kind of as safely as possible. And so to the extent that and that's going to depend on your story, right? If you're like a crypto trading company, you got to be real. I would not do that. And I think
Yeah.
that that's a bad story. But if you've got a legit thing that you're doing inside of the zone where you can show that you're actually positively impacting that zone by what you're doing, case in point, you've got like a artist studio where they're creating these NFTs and there's this creation thing happening. I think that that's fantastic. To Mike Chistay's question that's in the comments as well, if you've got a mining, like a Bitcoin mining operation that's happening in
Combine it
the
with
zone,
solar, baby.
exactly, and ideally where you've got a green component, whether that's solar or whether that's where you're burning off natural gas, I think that that's a really compelling story too, because hey, listen, we have actually rolled these new equipment into an opportunity zone, which is the whole point of this program, is we want to see increased activity in the zone, and now we're doing that in the zone. And you got to be careful about, to Brett's point, about retaining crypto on the books. This is actually a great question for you guys. If you're actively doing something, so let's say that you're going to use the Bitcoin in order to pay for more miners because you get a better deal by doing that, does that justify it as, holding that on the balance sheet of the QOZB?
Yeah, a lot to think about there. Thanks for addressing Mike's question. That was going to be, I wanted to tag you with that one. Let's move to Ginny's question here. Kind of a basic question. She's curious, what is the cost to establishing a fund? I think she's referring to, if I want to get my own qualified opportunity fund going and put some cash in it, put some gains dollars in it, how much does that cost? I think really establishing a fund is pretty simple. You can probably do it for a few $1,000s. It's really just creating an LLC, but it's the ongoing compliance where things get a little bit sticky. But what cost do you think Ginny should ballpark? Maybe initial setup and then annually.
Yeah, I think you're right on, Jimmy. I think it's probably a few $1,000s. You form the entity in any state. You got to get the EIN, really easy to do. You paper it with an operating agreement. You set up, the account with a bank, and I think OZ Pros has done like 1,000 of these already, right? I mean, it's pretty easy, but the compliance goes on for the next 10 years, and I think the real cost is: are you going to try and raise additional equity? Is it just a mom and pop fund, or are you trying to do other creative things? And I think that's where all of us can really add a lot of value.
Yeah. I think the cautionary tale is to hire a professional to help you walk through the compliance hurdles because, I'm sure you guys have as well, but I've spent a lot of time fixing DIY jobs and sometimes they're just not. Ideally you were able to pay with deferred gain and, so it doesn't come or is viewed as a cost, but rather a tax savings.
So we charge 12.5, right? That includes your QOF, your QAZB, all your ancillary documents, and then it gives you a year's worth of access to compliance to get your questions answered. We meet every Tuesday from 10 to 11:30 Eastern time, and we rapid fire questions and answers. And it allows you the chance to be able to strategically get your questions answered so that way you can take action and you can do it comfortably. It also allows you to learn from other people. And so that's how we kind of walk through the compliance piece as well. And then to the extent that you want us to handle the compliance, we build that on a like as complicated basis, but we could certainly do that going forward too. But to their point, definitely don't. I mean, and if you want to do it yourself, if you feel good about forming the entities, we've got that option as well. We've got all our documents that you can get a hold of, but you're definitely going to want to make sure that you're talking to somebody about it and that you're doing it correctly as you do it yourself.
It's really important to have a good accountant too. I mean, God knows there's CPAs out there that are really good at doing a lot of things that still don't know anything about this incentive. And we've already seen hundreds of examples of incorrect tax filings where the CPAs just did it wrong, made a simple mistake. So keep all that in mind.
Yeah, good points there. All right, let's move on to Howard's question here. Howard asked a little while ago, is there a rule where if one buys in an opportunity zone and across the street they also buy a lot, but that one's not in an opportunity zone, can one be able to include that non-OZ lot? How does that work? And I get this question a lot.
So it's not a straddle though, right? You've got two, it's clearly two separate.
It's two separate lots is what he's making it sound like.
Right. Well, you can have up to 30%, right? That's not qualified opportunity zone property in your business. So it just comes down to, how much are you building, where are you building, and is there a way to combine the parcels? I would say that might be your best bet. Ideally, more than 50% is in the OZ, and then if you can go through the local process and get those parcels or lots combined, I think that would probably be the best way to go.
But short of doing that, typically you can't qualify that non-OZ located lot as a good asset. It would be a bad asset in most cases.
It would have to be in that 30% bad asset bucket.
Right.
You can if it shares a common property line. That's
okay.
So if it shares a common property line, and that could actually be separated by either a road, a railroad, or a stream. And as long as it's only separated by that and it actually shares a property line, it can't be like catty corner like this, but as long as it shares a common property line and it's just separated by a street or a railroad, then as long as your property that's in the zone is more than 50% of the one that's outside of the zone, so it's double, it's basically in excess, so it's greater than 51%, then you can pull the one that's outside of the zone into the zone for purposes of the step up in basis to fair market value. But it's got to be used in the same trade or business, which would probably happen. I mean, I don't think it'd be that difficult to say, okay, yeah, we're going to use that area across the street for parking.
Yeah, we get asked that question a lot too, and our response is exactly the same. Two approaches you can take. One of them is the straddling approach, like Ashley just mentioned, and then the other one is just counting it as your 30% allowance as non-OZ property.
Excellent.
The nice thing is if you're improving it, the structures that you build on top of that are all going to be good assets. So over time, assuming you've got that 31-month safe harbor and you've got the 30 months to improve, the 30% bad asset now might only be 5% in 2 years once you've got your structure on it.
Excellent. Well, just a quick check of the clock. We've got about 5 or 6 more minutes here until we have to move on to our next presenters from Capital Square. They're going to be joining me for a roundtable discussion on the evolution of opportunity zones. So you don't want to miss that one. We've got a few more minutes here. I think everybody has now come back in the last 5 or 10 minutes from that breakout session with Russ Colvin and Your Space America. I gotta see the audience has ticked up significantly in the past few minutes here. So let's try to see if we can address just a couple more questions. And Ashley, I can see you furiously typing. I think you're typing to Tim in the Q&A because he had a pretty complicated situation. So thanks for getting him sorted out. I wanted to move on to these questions from Nick regarding asset test. Nick asked a two-part question here. Part one is on the 30% bad asset that QOZBs can hold. If a QOZB invests in, let's say, stocks, how is its market value determined? Is it at the price purchased or at the market price at the time of the asset test? Also, can I trim down the stock holdings right before that asset test and use it to pay down debt? And then his second part of his question is, while acquiring a residential rental OZ property, should it be purchased under a QOF or a QOZB? And also, who should hold the title? So multi-part question there from Nick. I don't know who wants to take a crack at that one first.
Yeah, I'm happy to take the first crack. So we've talked about, these 5 tests that a QOZB needs to satisfy in order to be treated as a QOZB for tax purposes. And if it doesn't satisfy any one of these tests, then it's just an LLC or a limited partnership or a corporation, and not this special tax status that we call qualified opportunity zone business. In your question, you mentioned one of those tests, this 30% bad asset test, but there's another rule in play, and it's called a non-qualified financial property test. And the reason why I bring it up is because stock is considered non-qualified financial property. And under this rule, a QOZB can't hold more than 5% of its assets in non-qualified financial property. So that would be a no-go. You're not going to want to use your QOZB to acquire and hold stock.
Well, that's a good point, Andrew. And I think another thing to think about is that those bad assets are going to get appraised throughout the 10 years. So I think he asked, well, what if the stock is worth X now and it's worth Y a year from now? I mean, you're gonna have to keep a really close accounting on just how much your stock portfolio is. So yeah, I agree. It's a risky play there.
So the way that it works, Jimmy, and this goes to any bad asset, right? Is it any bad asset that gets purchased, right? If it's, as long as it's purchased, then it will be at your unadjusted cost basis if you don't have financials, like audited financial statements. If you contribute that bad asset into your QOZB or your QOF, then it's going to get marked to market every 6 months. And you got to be really careful about that. And so the stock, right? Like, and I think that holding any kind of stock that's a non-opportunity zone business stock, certainly don't want to do that at the QOZB level. You can do it inside of the 10% at the QOF level, right? We get that 10% gimme. We can put that into anything we want, but you want to make sure that you actually purchase it. And so that goes from stock or to stock into an active entity. But if you were to like invest into, like, let's say that Brett was starting a business that was not in an opportunity zone, and I contributed into that LLC with my 10%, inside of my QOF, that's going to get marked to market every 6 months. So you got to be really careful about making sure that you follow the rules associated with that. Once again, hire a professional who knows what they're doing, who does nothing but opportunity zones, because these are some of the arcane things that have come up in working with these things since 2018.
Awesome. Gentlemen, we have run out of time, but really appreciate all 3 of you joining me today. Again, all 3 of these attorneys are nationally renowned. They speak frequently at conferences and at my webinars, and they're all members of my OZ Insiders Mastermind group. You can learn more about that group at ozinsiders.com. I posted links to the email addresses for each one of these individuals. I'll also, during our next segment, or when I get a chance to, I'll post LinkedIn information for each of them as well. So please don't hesitate to reach out to Andrew or Brett or Ashley, or maybe all 3 of them if you have any other questions. And I know we didn't get to everybody's questions in the chat. It's been a very packed audience today. I think we could probably go for another hour. We probably wouldn't answer everybody's questions. But gentlemen, again, thanks for joining me today. Really appreciate your time here on this latest edition of Ask the Opportunity Zone's Experts.